It's a tough time to be an investor. Warren Buffett's favorite market indicator surged to a record high, signaling stocks are overvalued and a crash could be around the corner. The so-called Buffett indicator is used to gauge whether the stock market is overvalued or undervalued relative to the size of the economy. The indicator predicted the 2001 and 2008 crashes, and it's flashing a warning sign again. When the ratio is higher than 100%, it means the global economy isn't keeping up with investors' optimism. And that's bad news for stocks. If you're a subscriber, well, welcome back to Investing View. But if you're new to this channel and you want to enjoy more of our engaging content, make sure to click that subscribe button and use that trigger finger to smash the like button. Now let's get into it. The Buffett indicator is calculated by dividing the combined market capitalizations of a country's publicly traded stocks by its quarterly gross domestic product, and expressed in percentage terms. The Wilshire 5000 Total Market Index was valued at about $35.5 trillion at a time, while the latest official estimate for second quarter U.S. GDP is $19.4 trillion. The Buffett indicator stands at 183% based on those figures, a significant increase from 170% on July 30th. Buffett described the yardstick as, quote, probably the best single measure of where valuations stand at any given moment in a Fortune magazine article in December 2001 after the dot-com bubble burst. Quote, nearly 2 years ago, the ratio rose to an unprecedented level, the billionaire investor and Berkshire Hathaway CEO said. That should have been a very strong warning signal. The indicator has a solid track record of predicting past downturns, as it soared before the 2008 financial crisis and the dot-com crash. Yes, it's far from perfect, as the GDP doesn't account for income earned overseas, and US-listed companies don't necessarily contribute much to the domestic economy. Moreover, the latest reading reflects a dramatic plunge in US GDP last quarter that could prove temporary as it reflected store closures, lockdowns, and travel restrictions in response to the coronavirus pandemic. The US government and Federal Reserve have also taken unprecedented steps to shore up financial markets and the economy, and may not allow a crash to occur. Their efforts to date include bailing out airlines and other distressed companies, buying individual corporate bonds, and sending out stimulus checks to households. Still, the Buffett indicator underscores the glaring disconnect between the stock market and the economy. Both the S&P 500 and NASDAQ closed at all-time highs, even though more than 57 million unemployment claims have been led during the pandemic. The global version of the gauge, which compares the total value of the world stocks to global GDP, spiked to a 30-month high. Quote, they know that overstaying the festivities, that is, continuing to speculate in companies that have gigantic valuations relative to the cash they are likely to generate in the future, will eventually bring on pumpkins and mice. Buffett warned Berkshire Hathaway stockholders back in 2000 regarding those gambling on sky-high internet stocks. He added, quote, but they nevertheless hate to miss a single minute of what is one hell of a party. Therefore, the giddy participants all plan to leave just seconds before midnight. There's a problem, though. They're dancing in a room in which the clocks have no hands. As a warning against the craziness of sky-high stock prices, Buffett's comments, of course, were on target. The tech-heavy NASDAQ Composite Index, which peaked at 5,049 shortly before Buffett sent out his stockholder letter, promptly collapsed over the next 2.5 years by 75%. Someone who invested in the index had to wait 15 years to see a new peak. They were in the red for all that time. And yes, we are clearly in some version of a second technology bubble. Today, the stocks in the NASDAQ Composite Index are valued in aggregate at a wild sky-high $17 trillion. That's equal to 90% of the entire U.S. gross domestic product, and more than half of the market value of all U.S. traded stocks. The NASDAQ Composite in relation to the broad market S&P 1500, SP 1500, is now nearly at the peak level seen during the madness of February through March 2000. Compared with the entire world stock markets, as measured by the MSCI All-Country World Index, there's one problem with Buffett's analogy. We are not dancing in a room, quote, in which the clocks have no hands. And even if things turn into pumpkins and mice figuratively, it is very unlikely to happen in an instant at midnight. The popular image of a stock market crash, Wall Street in 1929, the NASDAQ in 2000, is a sudden phenomenon that comes out of nowhere and is too fast to escape. But it's not true. The infamous dot-com bubble of 1999 to 2000 took 2.5 years to deflate fully. Along the way, ordinary investors had opportunities galore to get out with the most of their winnings. For instance, in September of that year, a full 6 months after the bubble had burst, the NASDAQ Composite was still higher than it had been in early February, when the bubble was nearing its peak. So the clocks didn't just have hands, they had alarms, and those were ringing like mad for months. This may not have helped you if you were buying the worst quality .coms, the ones that quickly went bankrupt, or trading with borrowed money. But if you were investing responsibly in the technology sector as a whole, the come down took a long time. It wasn't entirely dissimilar to the infamous crash of 1929. The market was sliding for a solid 6 weeks before the bottom dropped out, and even afterwards, there were plenty of opportunities to get out. The market rallied from November of that year through the following spring. The worst destruction didn't come until 1931 to 32, and that was largely in response to a series of disastrous policy moves made by the US and foreign governments. And in most crashes, the worst carnage isn't experienced by those who hung around a bit too long, but those who kept throwing good money after bad on the way down. Getting out of a boom too early could cost you almost as much money in missed profits as getting out too late costs you in losses. Many intelligent and responsible stock market gurus thought tech stocks were dangerously overvalued in 1997 and 98. But if you'd cashed out then, you would have spent the next couple of years kicking yourself as your former shares rose as much as 300% more. Selling out of the Wall Street boom of the late 1920s a year too early cost you nearly as much as selling out a year too late. You often make the biggest money in a bubble right at the end. As Peter Lynch, the legendary Wall Street investor and former Fidelity manager said, quote, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." Naturally, the question that really matters is where we are now. Okay, so maybe the dominant technology companies this time around, namely Apple, Amazon, Microsoft, Alphabet/Google, Netflix, and Facebook, aren't as crazy as big tech was 20 years ago. At the peak of the madness back then, Microsoft stock was valued at 113 times the per-share earnings of the previous 12 months, and Cisco Systems an epic 300 times. This time around, Microsoft, Apple, and Google are all on trailing price-earning ratios in the 30s, which are historically very high, but not quite as crazy as back then. Netflix, though, is 80 times trailing earnings, and Amazon more than 100 times. So what should a responsible investor do? Is it possible to minimize the risk of regret by selling often in small amounts? Market gurus point out that if stocks carry on rising, you will congratulate yourself on the ones you didn't sell. And if stocks fall, you'll congratulate yourself on the ones that didn't. It is also possible to hang on in case there is a further spike, while vowing to cash out when the index hits a stop loss of, say, 20% from the peak. Historically, that's worked pretty well, so as long as people stuck to it and actually did sell. So as long as the index is above its 200-day average, hang on and pay it no more attention. But if the index is below the average, don't think, just sell. And don't buy back until it gets back above the average again. You don't even have to take it to its extremes. You can stay, say, 75% invested in stocks so long as the index is above its 200-day average, and sell down to, say, 25% when it falls below. Astonishingly, it's managed to keep people invested in most booms and got them out of most bear markets early on. The very long-term investment returns are about the same as just buying and holding stocks, but this strategy has far less volatility and downside risk. Naturally, the past is no guarantee of future performance, and this and anything else. But if you carry on dancing, this allows you to keep an eye on the clocks and an ear out for the alarms. What can you say about Buffett's indicator sending a warning to all investors? Let us know in the comments below. And hey, if you enjoyed this video, don't forget to like and subscribe to our channel so we can continue giving you the best content. Thanks for watching, and see you in the next video.